Money, in the Elon Musk sense, is not the end goal, but the raw material of ambition. And understanding that distinction is the first step to understanding why his financial behavior often looks irrational to conventional investors. From the outside, Musk's approach appears reckless, repeatedly selling personal assets, concentrating wealth into a small number of extremely high-risk ventures, rejecting diversification as a principle, and tolerating years, sometimes decades, of losses, volatility, and public criticism. But beneath that surface is a coherent money strategy built around a single idea. Capital is most powerful when it is aggressively converted into progress. Musk does not treat money as something to be preserved, optimized for yield, or protected from downside at all costs. He treats it as fuel that must be burned in pursuit of outcomes that most people consider unrealistic. This mindset separates him sharply from traditional finance thinking, where money is typically framed as something to grow steadily, hedge carefully, and distribute across asset classes to reduce risk. Musk instead concentrates capital, time, and attention into narrow objectives, operating on the belief that asymmetric outcomes, those rare results that are orders of magnitude larger than the investment, are the only ones that matter. In this framework, losing money is not failure, stagnation is. This is why he repeatedly reinvests rather than extracting wealth for lifestyle security, even when doing so exposes him to extreme personal risk. His money strategy begins with first principles. If a problem is existentially important and solvable, then maximizing the probability of success is more valuable than protecting capital. That logic explains why he poured nearly all of his PayPal proceeds into Tesla and SpaceX at a time when both companies were close to collapse, leaving himself with little liquidity and no financial safety net. To a conventional investor, this violated every rule of prudent wealth management. To Musk, it was simply capital being allocated to its highest possible use. Another overlooked aspect of this strategy is his refusal to separate money from control. Musk consistently prioritizes ownership and decision-making authority over short-term financial optimization, even if that means accepting lower valuations, higher volatility, or public scrutiny. Control allows him to deploy capital according to long-term technical and strategic logic rather than quarterly expectations, which is critical when building capital-intensive systems like electric vehicle manufacturing, reusable rockets, or large-scale AI infrastructure. Most investors optimize for returns within existing systems. Musk invests to change the system itself. That difference has enormous implications for how money is deployed. Instead of seeking predictable cash flows, he seeks leverage over learning curves, cost curves, and technological inflection points. In practice, this means spending aggressively on engineering, manufacturing capacity, and vertical integration long before profits appear, because he views early losses as investments in future cost advantages. This also explains his tolerance for volatility in public markets. When many executives obsess over stock price stability, Musk appears largely indifferent to short-term market reactions, focusing instead on whether the underlying operational metrics, production rates, cost per unit, technological capability, are improving. From his perspective, money tied up in share buybacks, dividends, or financial engineering is largely wasted if it does not strengthen the core system. What most people ignore is that this strategy requires an unusual psychological relationship with money, a willingness to see large numbers not as security but as responsibility. Wealth, in this view, is not permission to retreat from risk, but an obligation to take on bigger problems. This mindset also shapes his personal financial decisions, such as selling real estate, avoiding luxury consumption, and keeping personal burn rate relatively low compared to his net worth. These are not symbolic gestures. They are practical choices that preserve flexibility and allow capital to remain concentrated where it can have the greatest impact. Another critical element of Musk's money strategy is time horizon. He evaluates financial decisions not on annual or even 5-year timelines, but on decades-long arcs tied to technological maturity and adoption. This long horizon radically changes what looks rational. Investments that appear unattractive under discounted cash flow models optimized for near-term returns can become compelling when viewed through the lens of compounding technological progress and scale effects. Musk's willingness to delay gratification, financial, reputational, and personal, allows him to endure periods where the numbers look bad on paper while the underlying trajectory improves. This is why he repeatedly emphasizes production, learning, and iteration over immediate profitability. Profit, in his model, is an output, not a target. When money is used correctly, profit eventually emerges as a byproduct of having built something fundamentally valuable and difficult to replicate. Most people miss this because they analyze Musk's decisions using frameworks designed for asset managers, not builders. Asset managers allocate money to optimize risk-adjusted returns within existing markets. Builders allocate money to create new markets or radically reshape old ones. The metrics, incentives, and tolerances are completely different. Musk's strategy also relies on a deep comfort with uncertainty. Rather than trying to eliminate unknowns through diversification, he attacks them through engineering and direct involvement, believing that understanding and control reduce risk more effectively than spreading capital thinly. This is why he often commits money before all variables are known, trusting that rapid iteration will resolve uncertainty faster than waiting for perfect information. To most people, this feels reckless. To Musk, delay itself is the greatest risk. Elon Musk's money strategy is not about getting rich, staying rich, or beating the market in a conventional sense. It is about converting capital into capability, using money as a tool to accelerate progress, accept volatility, and pursue outcomes so large that traditional risk calculations no longer apply. Everything else, stocks, crypto opinions, valuation debates, and headline-grabbing moves, flows from this underlying philosophy, which remains widely misunderstood precisely because it does not fit the mental models most people use to think about money. At the core of Elon Musk's money strategy is a principle that most people intellectually acknowledge but rarely practice. Concentration creates leverage, while diversification often creates comfort. Traditional finance teaches that spreading capital across many assets reduces risk, smooths returns, and protects against catastrophic loss. Musk operates from a different assumption entirely, that the greatest risk is allocating capital to things that do not materially change the outcome of the future you are trying to build. From this perspective, diversification is not safety, it is dilution. Money spread thinly across dozens of investments may preserve wealth, but it rarely creates anything transformative. Musk's financial behavior reflects a belief that if you have a sufficiently strong conviction about a small number of opportunities, concentrating capital, attention, and effort into those opportunities dramatically increases the probability of an outsized result. This is why, after selling PayPal, he placed the overwhelming majority of his net worth into just two companies, Tesla and SpaceX, at a time when both were fragile, capital-starved, and widely dismissed. To conventional investors, this looked like financial self-destruction. To Musk, it was a rational response to asymmetric opportunity. He was not trying to optimize his personal balance sheet. He was trying to maximize the probability that two world-changing systems, sustainable energy and reusable spaceflight, would survive long enough to reach escape velocity. This distinction is crucial. Diversification assumes you do not have control over outcomes and therefore must protect against randomness. Musk's approach assumes that control, understanding, and relentless execution can meaningfully shape outcomes, making concentrated bets logical rather than reckless. This does not mean he ignores risk, it means he defines risk differently. For most investors, risk is volatility or drawdown. For Musk, risk is losing the opportunity to solve a problem that matters. Money, in his framework, is most valuable when it removes constraints, funding engineers, building factories, accelerating iteration, rather than when it sits passively in a portfolio waiting to compound. This is also why he often reinvests capital internally rather than seeking external diversification. Instead of taking profits and allocating them to unrelated assets, he repeatedly channels cash back into expanding production capacity, reducing costs, and pushing technological boundaries. In Tesla's case, this meant prioritizing factories, supply chains, and vertical integration over short-term profitability. In SpaceX's case, it meant absorbing repeated launch failures and massive upfront costs to develop reusable rockets. Each of these choices increased short-term financial risk while simultaneously increasing long-term strategic leverage. What most people ignore is that concentration amplifies not only outcomes but learning. When capital is focused, feedback becomes immediate and unavoidable. Failures are felt directly, forcing rapid adaptation. Diversified portfolios, by contrast, often insulate decision-makers from learning because losses are averaged out and successes are attributed to market conditions rather than skill. Musk's concentrated exposure means he cannot hide from reality. When something breaks, he is forced to confront it head-on. This accelerates both technical and financial learning, allowing him to refine capital allocation decisions over time. Another overlooked element of this strategy is how concentration interacts with time horizon. Concentrated bets are intolerable if evaluated on short timelines because volatility dominates perception. On longer timelines, however, the signal-to-noise ratio improves dramatically. Musk appears willing to endure years of financial and public market discomfort in exchange for a chance at long-term dominance. This patience is not passive, it is paired with intense operational urgency. He waits for outcomes, not for effort. Capital is deployed aggressively, but results are allowed to mature slowly. This combination, high intensity with long patience, is rare and psychologically demanding, which is why most people default to diversification. Diversification reduces anxiety, concentration increases responsibility. When everything depends on a few decisions, excuses disappear. Musk's willingness to accept that pressure is central to his money strategy. It also explains why he often resists advice from traditional financial institutions, analysts, and risk managers whose frameworks are built around portfolio theory rather than system building. Their tools are designed to manage uncertainty, not to conquer it. Another important aspect of Musk's concentration strategy is alignment. By having most of his net worth tied to the same ventures he spends his time running, his incentives are perfectly aligned with long-term value creation rather than short-term financial extraction. This alignment is not just ethical, it is strategic. It allows him to make unpopular decisions, cutting costs, delaying profits, reinvesting aggressively, without the internal conflict that arises when personal wealth is decoupled from company performance. Many executives diversify their wealth precisely to reduce personal exposure, but that separation can weaken conviction at critical moments. Musk's financial exposure ensures that when he makes a decision, he feels its consequences fully, sharpening judgment rather than dulling it. Critics often argue that this approach is survivorship biased, pointing out that many concentrated bets fail catastrophically. Musk would likely agree, but that does not invalidate the strategy. It clarifies its prerequisites. Concentration only works when paired with deep understanding, extreme effort, and a willingness to endure prolonged adversity. Without those elements, concentrated capital becomes gambling. With them, it becomes leverage. This is why Musk invests primarily in domains he understands deeply and can influence directly, rather than in abstract financial instruments. He does not allocate money based on diversification models. He allocates it based on whether he can materially improve the odds through action. Even his public statements about stocks and crypto often reflect this mindset. He shows little interest in trading or timing markets, focusing instead on whether an asset aligns with long-term technological and economic trends he believes in. When he does engage, it is usually in ways that reinforce his broader strategic narrative rather than optimize short-term gains. Musk's money strategy is not replicable for most people because it demands a level of conviction, competence, and psychological resilience that diversification is specifically designed to avoid testing. Most people use diversification to protect themselves from being wrong. Musk concentrates because he is willing to be wrong repeatedly in pursuit of being right, once at a scale that overwhelms every failure. This is why his financial behavior looks extreme, even irresponsible, through the lens of conventional investing, yet coherent and even inevitable when viewed through the lens of building systems that redefine industries. Concentration in his world is not a flaw. It is the mechanism by which money stops being a scorecard and starts becoming a force. A third pillar of Elon Musk's money strategy, one that is frequently misunderstood or ignored, is his relentless preference for converting capital into physical and technical capability rather than financial optionality. In traditional finance, capital is often valued for its flexibility. Cash provides optionality, liquidity allows maneuvering, and reserves act as insurance against uncertainty. Musk views this differently. To him, idle capital is a liability if it is not actively increasing the probability of long-term success. This is why, across his companies, money is aggressively transformed into factories, machines, infrastructure, and engineering talent long before profits justify the expense on a spreadsheet. Where many executives preserve cash to satisfy markets or hedge against downturns, Musk spends into uncertainty, believing that capability compounds faster than cash when deployed correctly. A factory once built and optimized permanently lowers marginal costs. An engineering team once trained through repeated iteration permanently raises the organization's problem-solving capacity. These are not reversible investments, and that irreversibility is precisely the point. Musk consistently chooses paths that force commitment, because commitment eliminates the temptation to retreat when conditions become uncomfortable. This mindset explains why Tesla built gigafactories years before demand was obvious to analysts, why SpaceX invested heavily in reusable rocket technology before it was proven viable, and why Musk often accelerates spending during periods when critics argue for caution. In his framework, money is most powerful when it hardens into something that competitors cannot easily replicate or reverse. Cash can be matched by anyone with access to capital markets. Deep operational capability cannot. This preference also reframes how risk is assessed. Financial risk in Musk's world is often a byproduct of underinvestment in capability rather than overinvestment. A company that saves money by delaying infrastructure tooling or automation may look prudent in the short term, but becomes fragile when scale is required. Musk repeatedly demonstrates a willingness to absorb near-term financial pain to avoid long-term operational bottlenecks. This is why Tesla often appears to be perpetually reinvesting, perpetually on the edge, from the outside. The goal is not comfort, but momentum. Another dimension of this strategy is vertical integration. Instead of relying heavily on suppliers and partners to manage capital-intensive components, Musk prefers to internalize those functions even when it appears inefficient initially. Vertical integration demands more upfront capital, but it converts money into control over cost, quality, and iteration speed. By owning more of the stack, Musk reduces dependency risk and gains the ability to optimize the entire system rather than negotiate within it. This approach is capital hungry and often criticized by analysts trained to favor asset-light models, but it aligns perfectly with his belief that long-term advantage comes from mastering the underlying physics, manufacturing processes, and constraints of a system. Money in this sense is used to buy learning. Each dollar spent is expected to yield not just output, but information about materials, processes, failure modes, and scaling limits. That information then feeds back into better capital allocation decisions, creating a compounding loop between spending and understanding. What most people miss is that this loop cannot be built through financial engineering. Stock buybacks, dividends, and balance sheet optimization may please markets, but they do little to deepen an organization's understanding of its core problems. Musk's resistance to these practices is not ideological, it is practical. He sees them as distractions from the primary task of building systems that work better and cheaper over time. This is also why he often emphasizes cost reduction through design and process rather than through financial restructuring. Reducing the cost of a battery, a rocket launch, or a vehicle platform by rethinking its design has a permanent effect on economics, whereas cutting costs through layoffs or accounting adjustments often creates hidden fragility. Musk's money strategy prioritizes the former because it converts capital into durable advantage. There is also a psychological component to this approach that is easy to underestimate. By committing money to tangible projects, Musk creates visible progress that reinforces belief internally and externally. Engineers are more motivated to solve hard problems when they see resources being committed decisively rather than rationed defensively. This morale effect matters in high-stress, long-horizon projects where setbacks are inevitable. Capital deployment becomes a signal of confidence both to teams and to the market, that the mission is worth pursuing despite uncertainty. This signaling effect is subtle but powerful, and it is lost when companies hoard cash out of fear. Another important aspect is how Musk treats sunk costs. Once capital has been converted into capability, he is surprisingly willing to abandon or radically change direction if the underlying assumptions prove wrong. This flexibility exists precisely because the investment was made in learning rather than in financial positioning. A factory layout can be redesigned, a production process can be retooled, a rocket can be iterated. These changes may be expensive, but they are possible because the organization has internal capability. Financial instruments, by contrast, often lock decision makers into positions that are harder to unwind without reputational or market damage. Musk's willingness to throw away work that no longer serves the mission is another reason he prefers to spend money on building things rather than optimizing financial metrics. Critics often interpret this as waste, but in Musk's framework, waste is acceptable if it accelerates convergence toward a better solution. What is truly wasteful, in his view, is spending money in ways that do not improve the system's ability to perform in the future. This philosophy also influences how Musk interacts with capital markets. He uses them when necessary to fund growth, but resists allowing them to dictate operational decisions. Equity raises, debt issuances, and stock volatility are treated as tools and side effects, not as guiding signals. The real metrics that matter are throughput, cost curves, and technological readiness. Money flows toward these metrics because they determine long-term survival and dominance. Musk's money strategy is not primarily financial at all, it is industrial and technological. Capital is valuable only insofar as it can be transformed into machines, knowledge, and systems that outperform alternatives over time. This stands in sharp contrast to a financialized worldview where money makes money through abstraction. Musk's worldview is physical. Money makes progress by reshaping reality. Most people ignore this because it requires thinking beyond balance sheets and into factories, physics, and process flows. But once this lens is adopted, many of his seemingly aggressive or reckless financial decisions begin to look like consistent expressions of a single belief, that the fastest way to create lasting value is to turn money into capability as early and as decisively as possible, even when the payoff is uncertain and far away. Another dimension of Elon Musk's money strategy that most people overlook is how deeply it is shaped by his relationship with time, especially his refusal to price the future using the same mental discounting that dominates conventional finance. Traditional investing relies heavily on models that aggressively discount future value, treating distant outcomes as increasingly irrelevant compared to near-term cash flows. Musk operates with an almost inverted logic. He treats the future not as a vague abstraction to be discounted, but as a concrete destination that must be engineered toward deliberately. This fundamentally changes how money is valued and deployed. In his framework, capital spent today is justified not by what it produces next quarter, but by how much it accelerates arrival at a future state where costs collapse, capabilities expand, and competitive dynamics shift irreversibly. This is why Musk is willing to endure prolonged periods where financial statements look weak or even alarming, so long as the underlying trajectory is moving in the right direction. Time, to him, is not merely a variable in a spreadsheet. It is the most critical strategic asset. Money that shortens timelines is vastly more valuable than money that simply earns a return. This is evident in how aggressively he prioritizes speed, often at the expense of short-term efficiency. In many organizations, saving money by moving slowly is seen as prudence. Musk sees slow progress as one of the most expensive mistakes a company can make, because delays compound just as powerfully as interest does. Every year lost to hesitation is a year competitors catch up, technologies stagnate, or external conditions change. From this perspective, spending more now to move faster is not wasteful. It is economical in the deepest sense. This temporal lens also explains his resistance to incrementalism. Many companies attempt to stage investment carefully, releasing capital only after milestones are proven and risks reduced. Musk often does the opposite, committing large amounts of money early to compress development cycles and force learning to happen faster. This front-loading of risk looks dangerous when judged by short-term metrics, but it can dramatically improve long-term outcomes by revealing constraints early and enabling rapid iteration. In essence, Musk uses money to buy time, even when that time is purchased at a high financial cost. Another implication of this time-centric strategy is his tolerance for volatility. Market swings, public criticism, and even temporary collapses in valuation are treated as noise if they do not alter the long-term path. This does not mean Musk is indifferent to markets, but rather that he does not allow short-term sentiment to dictate capital deployment. He understands that markets are excellent at pricing the present and notoriously poor at pricing the distant future, especially when that future depends on non-linear technological progress. As a result, he often acts counter-cyclically, investing most aggressively when skepticism is highest and external validation is lowest. This is psychologically difficult because it requires separating signal from noise over long periods of time, resisting both fear and euphoria. Most people ignore this aspect of his strategy because it is emotionally uncomfortable. It demands faith in a process, rather than reassurance from immediate results. Time horizon also shapes how Musk thinks about profitability. In conventional business thinking, profitability is often treated as a prerequisite for legitimacy. Musk flips this relationship, treating profitability as an emergent property that appears once scale, efficiency, and technology reach a certain threshold. Until that threshold is crossed, profits are less important than progress. This does not mean he disregards economics. On the contrary, his obsession with cost reduction shows a deep respect for economic reality. But he understands that premature optimization for profit can lock systems into suboptimal designs that are hard to escape later. By delaying profitability, he preserves freedom to redesign processes, materials, and architectures in ways that would be impossible if margins were already being extracted. Money, in this sense, is sacrificed in the present to preserve optionality in the future. This is a subtle but powerful inversion of standard financial logic, and it explains why Musk's companies often look unprofitable, right up until the moment they suddenly aren't. Another overlooked component of this time-based strategy is how it influences Musk's personal financial behavior. He consistently aligns his personal liquidity with the timelines of his companies, even when doing so exposes him to personal risk. Rather than extracting wealth early and insulating himself from downside, he remains financially tethered to long-term outcomes. This creates an unusual symmetry between his personal incentives and the temporal demands of his projects. When timelines stretch, he stretches with them. This alignment reinforces patience internally and signals commitment externally, strengthening trust among employees, partners, and even some investors. It also removes the temptation to optimize for short-term exits or cosmetic improvements that boost valuation without improving fundamentals. Time horizon in this way becomes a governance mechanism as much as a strategic one. Critics often argue that such patience is a luxury afforded only to the extremely wealthy, but this misses the deeper point. Musk did not adopt a long time horizon because he was wealthy. He became wealthy because he adopted one early and adhered to it under pressure. His early decisions at PayPal, Tesla, and SpaceX already reflected this mindset long before outcomes were assured. This suggests that time horizon is not merely a consequence of success, but a driver of it. Money strategies built around short horizons tend to optimize for extractable value, while strategies built around long horizons optimize for transformative value. The latter are rarer precisely because they demand enduring uncertainty without external validation. Another reason this aspect of Musk's strategy is ignored is that it clashes with the rhythms of public markets and media cycles. Quarterly reporting, daily stock prices, and constant commentary create a narrative environment that rewards short-term explanations and punishes long-term ambiguity. Musk frequently clashes with this environment because he refuses to translate long-term plans into short-term promises. Instead, he communicates in terms of direction and inevitability, trusting that results will eventually justify the approach. This often creates tension with analysts and commentators who demand immediate clarity. But from Musk's perspective, over-communicating short-term expectations can be more damaging than under-communicating, because it anchors stakeholders to timelines that may need to shift as reality unfolds. Money, again, is used to maintain flexibility rather than to purchase certainty. Time also plays a crucial role in how Musk thinks about competition. He does not aim to beat competitors quarter by quarter. He aims to outrun them over decades. This means investing in capabilities that may not pay off immediately but create widening gaps over time. Examples include proprietary manufacturing processes, custom software, and vertically integrated supply chains. These investments are expensive and slow to mature, but once established, they compound relentlessly. But competitors who optimize for near-term financial metrics often cannot justify similar spending, leaving them trapped in local optima. Musk's willingness to accept near-term financial pain for long-term dominance is thus a strategic weapon, enabled by his distinctive treatment of time. This approach also reframes the concept of prediction, which is often misunderstood in discussions of Musk's financial thinking. He does not attempt to predict markets in the traditional sense. Instead, he predicts trajectories, learning curves, cost curves, and adoption curves driven by physics and engineering rather than sentiment. Money is allocated based on these trajectories, not on macro forecasts or market timing. This is why he can appear simultaneously indifferent to financial orthodoxy and deeply rational within his own framework. The future he is pricing is not speculative. It is constructed. Elon Musk's money strategy lies a radical reorientation toward time. Money is valuable not because it earns interest, but because it compresses timelines, accelerates learning, and enables compounding advantages that only reveal themselves over long horizons. Most people ignore this because it requires abandoning the comfort of near-term metrics and embracing a form of strategic patience that feels risky and unrewarding for long stretches. Yet it is precisely this willingness to subordinate short-term financial appearance to long-term structural progress that allows Musk to deploy money in ways that reshape industries rather than merely participate in them. A fifth, and perhaps most misunderstood component of Elon Musk's money strategy is how he thinks about risk, not as something to be minimized through avoidance, but as something to be reshaped through understanding, engineering, and direct confrontation. In conventional finance, risk is typically quantified as volatility, downside deviation, or probability-weighted loss. These abstractions lead to strategies focused on hedging, diversification, and insurance. Musk operates with a more primitive, but arguably more powerful definition. Risk is the probability that a project fails to achieve its underlying objective. Everything else, price swings, public criticism, temporary losses, is secondary. This framing radically alters how money is allocated. Instead of asking how to protect capital from adverse outcomes, Musk asks how to use capital to eliminate the causes of failure themselves. Money becomes a tool for attacking risk at its root rather than buffering against its symptoms. This is why his companies often appear to take on enormous financial exposure without corresponding hedges. To Musk, hedging financial risk without reducing technical or operational risk is a false sense of security. If a rocket fails because its engine design is flawed, no amount of financial hedging will fix that. Only better engineering will. Thus, capital is deployed toward redesign, testing, iteration, and redundancy, not toward financial instruments that merely soften the blow of failure. This approach explains why SpaceX spent heavily on repeated launches despite early failures. Each failure was expensive in financial terms, but invaluable in reducing future mission risk. Musk viewed the money spent on failed launches not as losses, but as investments in information. Information that competitors without launch experience could not easily acquire. In this way, spending money actually reduced risk over time, even as it increased short-term financial exposure. This inversion of the typical risk-reward relationship is central to his strategy. Another dimension of this philosophy is Musk's distinction between known risks and unknown risks. Traditional investors often avoid uncertainty by staying within familiar domains, preferring businesses with stable cash flows and predictable markets. Musk, by contrast, is drawn to uncertainty because it represents opportunity for differentiation. Unknown risk can be converted into known risks through effort and experimentation, whereas known risks are often priced efficiently by the market, leaving little upside. Money in this context is used to buy clarity. Each experiment, prototype, or test reduces uncertainty and shifts the risk profile of the project. This is why Musk favors rapid iteration over prolonged analysis. Waiting for perfect information is itself risky because it allows uncertainty to persist. Spending money to test assumptions, even when those tests might fail, accelerates the transition from unknown to known. Once risks are understood, they can be engineered around, mitigated, or accepted consciously. This process-oriented view of risk is often invisible to outsiders, who focus on outcomes rather than on how uncertainty is being systematically reduced. Another overlooked aspect of Musk's risk strategy is his willingness to stack risks deliberately. In finance, stacking risks is usually discouraged. Correlations increase the chance of catastrophic loss. Musk sometimes does the opposite, taking multiple risks simultaneously: technical, financial, reputational, when he believes they are linked and can be addressed together. For example, building a new factory using unproven manufacturing processes while ramping production and managing public scrutiny would be considered reckless by most executives. Musk accepts this because solving these problems in isolation would take too long. By confronting them together, he compresses timelines and forces integrated solutions. This increases the chance of near-term crisis, but also increases the chance of long-term breakthrough. Money is the enabler of this approach because it provides the resources needed to absorb shocks while learning occurs. The key is that these risks are not independent gambles. They are components of a single system being pushed toward a new equilibrium. Understanding this distinction is critical. From the outside, it looks like chaos. From the inside, it is controlled stress testing. Musk's approach also reveals a nuanced attitude toward failure. He does not seek failure, but he accepts it as an unavoidable byproduct of attempting difficult things quickly. This acceptance is not emotional resignation, it is strategic pragmatism. By budgeting for failure, financially, psychologically, and organizationally, he removes its power to paralyze decision-making. Money plays a central role here. When capital is allocated with the assumption that some portion will be wasted on dead ends, teams are freer to explore bold solutions without fear of punishment for not being immediately right. This freedom accelerates innovation and surfaces better options sooner. Most organizations claim to tolerate failure, but their financial structures betray them. Budgets are tight, margins are thin, and mistakes are penalized implicitly. Musk's willingness to absorb financial losses in pursuit of learning makes his tolerance for failure credible rather than rhetorical. Another critical piece of this risk philosophy is Musk's personal exposure. Unlike executives who insulate themselves financially through diversification and compensation structures, Musk often places his own wealth directly at risk alongside his company's. This personal exposure changes the texture of risk-taking. It forces discipline and seriousness because the consequences are real and personal. At the same time, it aligns his incentives perfectly with the reduction of fundamental risk rather than the management of appearances. When your own capital is on the line, cosmetic solutions lose their appeal. You are incentivized to solve the actual problem, not just explain it away. This alignment also enhances trust internally. Employees know that when Musk pushes for aggressive spending or rapid execution, he is not gambling with someone else's money alone. That shared exposure creates a culture where risk is taken seriously but not feared. Another subtle but important aspect of Musk's strategy is how he differentiates between reversible and irreversible decisions. He is willing to take extreme risks on decisions that can be reversed or iterated upon, while being more cautious with those that lock in permanent constraints. Money is used to increase reversibility where possible. For instance, investing in flexible manufacturing lines or modular designs allows changes to be made without starting from scratch. This reduces the true risk of bold moves because mistakes can be corrected. Financial risk models often fail to capture this nuance, treating all expenditures as equally binding. Musk's engineering mindset allows him to see where money can buy optionality rather than destroy it. This is another reason his risk tolerance appears higher than it actually is. He is not reckless across the board. He is selective, aggressive where reversibility is high and more deliberate where it is low. Public perception often misses this because reversibility is invisible until it is exercised. The relationship between risk and narrative also plays a role in Musk's money strategy. Markets, media, and the public construct stories around risk that can amplify or dampen perception independently of reality. Musk seems acutely aware of this, yet he chooses not to manage narrative in the traditional way. Instead of smoothing volatility through cautious messaging, he often communicates bluntly or provocatively, increasing perceived risk even as underlying fundamentals improve. This appears counterintuitive, but it serves a purpose. By allowing narrative risk to spike, he keeps financial pressure high, which in turn maintains urgency and focus internally. When everything feels precarious, complacency has no place to hide. Money, again, is used to sustain this high-pressure environment, by ensuring that resources are available to act decisively even when sentiment is negative. This dynamic is uncomfortable for investors accustomed to stable messaging, but it is consistent with Musk's belief that comfort is the enemy of progress. Another reason people misunderstand this aspect of his strategy is that they conflate risk-taking with prediction. Musk is often described as someone who bets on the future, implying speculative foresight. In reality, he is less interested in predicting outcomes than in creating conditions where favorable outcomes become more likely. Money is allocated not because he knows the future with certainty, but because he believes that concentrated effort, rapid learning, and relentless iteration can bend probabilities over time. This is a subtle but profound distinction. Predictors try to guess what will happen. Builders try to make something happen. Risk, in this sense, is not a dice roll, but a variable to be manipulated. By investing in capability, control, and speed, Musk reduces dependence on external conditions and increases agency. This agency-centric view of risk is rare in finance, which often treats individuals as price takers rather than system shapers. Elon Musk does not fear risk because he does not outsource responsibility for it. Instead of hiding behind models, diversification, or consensus, he confronts risk directly by spending money to understand, reduce, and reconfigure it. This approach demands a level of involvement, competence, and emotional resilience that most people are unwilling or unable to sustain. As a result, it is often labeled reckless or arrogant by observers who evaluate risk solely through financial metrics. Yet when viewed through Musk's lens, it becomes clear that his willingness to deploy money aggressively is not about gambling. It is about refusing to accept risk as an immutable fact, and instead treating it as a problem to be solved. A sixth and deeply underestimated element of Elon Musk's money strategy lies in how he treats public markets, valuation, and investor sentiment not as guiding forces, but as lagging indicators of real progress. For most executives and investors, market reaction is treated as a form of collective intelligence, a signal to be respected, anticipated, and managed carefully. Musk flips this relationship. He treats markets as mirrors, not maps. They reflect perceptions, emotions, and partial information, but they do not tell you where to go. This distinction profoundly shapes how money is raised, deployed, and interpreted across his ventures. Rather than optimizing decisions to maintain stable valuations or satisfy quarterly expectations, Musk consistently prioritizes actions that strengthen underlying reality, even if those actions temporarily damage market confidence. In his framework, valuation follows capability, not the other way around. This is why Tesla's market story has often seemed disconnected from its stock price at any given moment. Periods of intense operational progress, factory build-outs, cost breakthroughs, production learning have frequently coincided with stock volatility or skepticism, while periods of market enthusiasm have sometimes occurred when fundamentals were still catching up. Musk appears comfortable with this dissonance because he understands that markets react to narratives faster than they react to physics, and physics always wins eventually. Money, therefore, is allocated based on what improves the physical and operational reality of the business, not on what improves perception in the near term. This explains his frequent clashes with analysts and investors who demand clearer guidance, smoother earnings trajectories, or more conventional capital returns. From Musk's perspective, such demands often prioritize explainability over effectiveness. He is willing to endure misunderstanding if it allows the company to move faster toward a structurally superior position. Another consequence of this mindset is how Musk approaches capital raising. He does not raise money simply because markets are receptive or valuations are high. He raises money when capital can be immediately converted into progress. Timing matters less than purpose. When Tesla or SpaceX raises funds, the implicit question is not, can we get good terms, but can we use this money right now to materially change our trajectory? If the answer is yes, dilution is acceptable. If the answer is no, capital is unnecessary regardless of how favorable conditions appear. This is a stark departure from the opportunistic fundraising strategies common in venture and public markets, where companies often raise because they can rather than because they must. Musk's restraint in this area is often overlooked because attention tends to focus on the size of the raises rather than on their intent. When money is raised, it is usually followed by rapid deployment into factories, equipment, and talent, leaving little idle capital. This reinforces the principle that money is a means, not a trophy. Another subtle aspect of Musk's interaction with markets is his tolerance for ambiguity. Markets dislike uncertainty, and most executives work hard to eliminate it through guidance, forecasts, and carefully curated messaging. Musk often does the opposite, openly acknowledging uncertainty and refusing to commit to precise timelines or outcomes. This frustrates analysts but serves a strategic purpose. By avoiding rigid promises, he preserves flexibility to adapt as reality unfolds. Money, again, plays a central role. Capital is allocated in a way that allows for course correction rather than locking the organization into a single path dictated by prior commitments to the market. This flexibility is invaluable in domains where technological progress is nonlinear and surprises are inevitable. While this approach can depress valuations in the short term, it reduces the risk of catastrophic misalignment between expectations and execution. Another reason Musk appears indifferent to market sentiment is that he does not rely on markets for validation of his ideas. Many leaders subconsciously seek reassurance from rising stock prices or positive coverage, allowing sentiment to influence decision-making. Musk seems largely immune to this feedback loop. His confidence comes from internal metrics, production rates, cost reductions, test results, not from external applause. This internal locus of validation allows him to maintain consistency in capital allocation even when sentiment swings wildly. It also explains why he is willing to make unpopular decisions, such as cutting prices, increasing spending, or delaying profitability, when internal data suggests it is necessary. From a market perspective, these moves can look erratic or contradictory. From Musk's perspective, they are simply responses to reality. Money flows toward what reality demands, not toward what investors expect. Another important dimension of this strategy is how Musk treats stock ownership itself. Rather than viewing shares as abstract financial instruments, he treats them as claims on future productive capacity. This aligns with his reluctance to engage in financial maneuvers that artificially boost stock price without improving fundamentals. Share buybacks, aggressive leverage, or accounting optimizations are rarely central to his strategy because they do not enhance the company's ability to build, learn, or scale. When such tools are used, they are secondary to operational priorities. This often puts him at odds with investors who prioritize capital returns over reinvestment. Musk's response is implicit rather than explicit. Those who share his long-term vision will stay. Those who do not may leave. This filtering effect gradually shapes the shareholder base into one more tolerant of volatility and long-term investment, further reinforcing his freedom to allocate capital aggressively. Another overlooked aspect of Musk's relationship with markets is his willingness to let mistakes be visible. Public markets punish error harshly, which encourages many executives to hide or minimize failures. Musk often does the opposite, allowing problems to surface publicly and addressing them directly. This transparency increases short-term reputational and financial risk but strengthens long-term credibility. Money is spent to fix problems rather than to conceal them. Over time, this builds trust with stakeholders who value honesty over polish. It also accelerates learning because issues are confronted openly rather than festering beneath the surface. This approach is psychologically taxing, but it aligns with Musk's broader philosophy that reality is the ultimate arbiter and pretending otherwise only delays progress. The way Musk handles market cycles further illustrates this point. During periods of exuberance, he often sounds cautious, warning about overconfidence or excessive expectations. During downturns, he tends to emphasize fundamentals and execution rather than sentiment. This counter-cyclical communication style reinforces the idea that markets are not to be followed blindly. Money decisions remain anchored to long-term objectives regardless of whether sentiment is favorable or hostile. This steadiness is rare, particularly in environments where public scrutiny is intense and constant. It requires a level of detachment from external validation that most leaders struggle to maintain. Critics sometimes interpret this as arrogance or disregard for investors. But a more accurate interpretation is that Musk places a higher duty on building durable systems than on managing perceptions. Investors, in his view, are partners in a long-term project, not customers to be appeased continuously. This philosophy also shapes how Musk thinks about prediction in financial markets. He does not attempt to forecast stock prices, macro cycles, or short-term movements. Instead, he focuses on variables he believes are controllable: technology readiness, cost curves, production capacity, and adoption potential. Money is allocated to improve these variables with the expectation that markets will eventually reflect those improvements. This approach accepts that timing is uncertain and that markets may misprice reality for extended periods. Rather than fighting this uncertainty, Musk absorbs it as a cost of pursuing transformative goals. Elon Musk's money strategy deliberately decouples decision-making from market sentiment. By treating valuation as an outcome rather than a constraint, he preserves the freedom to deploy capital where it has the greatest long-term impact. Most people ignore this because it conflicts with the prevailing belief that markets are always right in the short term. Musk's experience suggests a more nuanced truth. Markets are informative, but they are not authoritative. Money, when guided by conviction, competence, and a long-time horizon, can move ahead of consensus, and in doing so, shape the very reality that markets eventually come to recognize. A seventh, often overlooked layer of Elon Musk's money strategy is how deeply it is intertwined with incentives, specifically his insistence on structuring financial flows in a way that aligns behavior with outcomes rather than appearances. In many organizations, money moves according to hierarchy, precedent, or political compromise, creating incentive structures that reward risk avoidance, consensus building, and short-term optics. Musk actively resists this dynamic. He treats money as a signal, not just a resource, and he is highly deliberate about where that signal is sent. Capital, compensation, and attention are directed toward areas where they reinforce the behaviors most likely to move the system forward, even when those behaviors are uncomfortable or unpopular. This is why Musk often channels disproportionate resources toward engineering, manufacturing, and problem-solving roles rather than toward layers of management, marketing, or financial optimization. In his worldview, incentives shape reality faster than strategy documents ever could. If engineers are empowered, resourced, and rewarded for solving hard problems, the system evolves. If they are constrained by budget politics or risk-averse oversight, progress stalls regardless of how ambitious the stated vision may be. Money, therefore, is not neutral. It actively sculpts organizational behavior. This philosophy extends to how Musk thinks about personal incentives as well. Unlike many executives who optimize compensation packages to extract value, independent of long-term outcomes, Musk ties his financial upside almost entirely to extreme performance thresholds. This creates a structure where rewards only materialize if extraordinary results are achieved, not merely adequate ones. Such arrangements are often criticized as theatrical or ego-driven, but they serve a practical function. They make incentives legible and unambiguous. When compensation is binary and outcome-dependent, it clarifies priorities across the organization. There is no confusion about what matters. This clarity cascades downward, influencing how managers allocate budgets, how teams prioritize projects, and how individuals assess trade-offs. Money becomes a tool for coherence rather than a source of distortion. Another critical aspect of this incentive-driven strategy is Musk's intolerance for misaligned financial motivations. When parts of an organization benefit from outcomes that harm the whole, such as departments optimizing for their own metrics at the expense of system performance, he intervenes aggressively. This often involves reallocating budgets, restructuring teams, or eliminating roles that exist primarily to manage complexity rather than reduce it. From a traditional corporate perspective, these moves can seem disruptive or harsh. From Musk's perspective, they are necessary corrections to incentive drift. Over time, even well-intentioned systems accumulate inefficiencies as people respond rationally to local incentives. Musk's willingness to repeatedly reset those incentives, even at high emotional and financial cost, is central to how he keeps money working toward long-term goals. Another dimension of this strategy is his skepticism toward external incentives imposed by markets, regulators, or cultural expectations. While he operates within these constraints, he resists allowing them to dominate internal decision-making. For example, quarterly earnings targets are treated as reporting requirements rather than strategic objectives. This reduces the pressure to allocate money in ways that smooth results artificially, such as delaying necessary spending or accelerating revenue recognition. Instead, capital is deployed according to what improves the system's trajectory, even if it creates short-term volatility. This approach demands a high tolerance for criticism because it violates deeply ingrained norms about how public companies are supposed to behave. Musk accepts this cost because he views misaligned incentives as far more dangerous than negative headlines. Another subtle but powerful element of his incentive philosophy is how he uses scarcity. Contrary to the assumption that innovation flourishes only in abundance, Musk often imposes tight constraints on time, budget, or resources to sharpen focus. Money is allocated generously where it removes fundamental bottlenecks, but it is withheld where abundance would encourage complacency. This selective scarcity forces teams to prioritize ruthlessly, simplifying designs and eliminating unnecessary features. It also mirrors Musk's personal financial behavior, where he avoids lavish consumption despite enormous wealth. This is not asceticism for its own sake. It is a way of maintaining sensitivity to trade-offs. When money feels infinite, decisions lose weight. By keeping financial pressure present, Musk ensures that every dollar spent is interrogated for its contribution to progress. This pressure is uncomfortable, but it drives efficiency at a level that formal cost controls rarely achieve. Another aspect of incentive alignment in Musk's strategy is transparency. He frequently shares financial realities, cash burn, production constraints, existential risks, directly with teams rather than insulating them from bad news. This transparency aligns incentives by making consequences visible. When people understand how close a project is to failure or success, they adjust behavior accordingly. Money becomes a shared concern rather than an abstract concept managed by a distant finance department. This collective ownership of financial reality strengthens accountability and reduces the temptation to externalize responsibility. It also accelerates problem solving because teams are more likely to act decisively when they grasp the stakes. Many organizations avoid this level of transparency out of fear that it will demoralize employees. Musk appears to believe the opposite, that adults perform better when they are trusted with the truth. Another overlooked incentive mechanism in Musk's approach is how he treats status. In many corporate environments, money flows toward roles with prestige rather than impact, reinforcing hierarchies that are disconnected from value creation. Musk actively undermines this dynamic by elevating technical excellence and execution over titles or seniority. Compensation, recognition, and influence tend to accrue to those who solve the hardest problems, regardless of their position in the formal hierarchy. This sends a powerful signal about what the organization values, shaping career incentives over time. Money, again, is used as a language, communicating priorities more effectively than slogans or mission statements ever could. This focus on incentives also extends to Musk's views on ownership and dilution. While he is willing to accept dilution to fund growth, he is careful to preserve incentive alignment among key contributors. Equity is treated not as a perk, but as a responsibility, a claim on future outcomes that comes with corresponding expectations of effort and commitment. This framing discourages passive ownership and encourages active participation in value creation. It also reinforces long-term thinking because equity rewards are realized over time rather than immediately. This stands in contrast to compensation structures that emphasize short-term bonuses, which often distort behavior toward easily measurable but strategically shallow goals. Musk's approach recognizes that what gets rewarded gets repeated, and he designs financial systems accordingly. Another reason this aspect of his strategy is ignored is that incentives operate quietly. They shape behavior incrementally over months and years, rather than producing dramatic, headline-grabbing moments. Observers tend to focus on Musk's bold statements or high-profile decisions, overlooking the mundane but powerful ways money is used to steer behavior internally. Yet it is precisely this steady alignment of incentives that allows his organizations to operate at such high intensity without collapsing under their own complexity. When incentives are aligned, friction decreases. When they are misaligned, no amount of capital can compensate. Musk's insistence on alignment also explains his impatience with bureaucratic processes that separate decision-making from consequence. Committees, excessive approvals, and diffuse accountability all weaken the link between action and outcome, blunting incentives. Money spent in such systems often fails to produce results because responsibility is fragmented. Musk's preference for small, empowered teams with clear ownership ensures that financial decisions translate directly into action. This tight coupling between money and responsibility is another reason his approach scales differently from traditional corporate models. Musk believes that most failures are not caused by lack of talent or ideas, but by misaligned incentives that reward the wrong behaviors. Money, therefore, is not just a medium of exchange. It is a design tool for shaping human behavior within complex systems. By obsessing over how incentives operate at every level, from personal compensation to organizational budgeting to market interaction, Musk ensures that capital flows in ways that reinforce progress rather than undermine it. Most people ignore this because incentives are invisible until they fail, and by then the damage is often entrenched. Musk's willingness to constantly redesign incentive structures, even at the cost of disruption and criticism, is a central reason his money strategy works in practice rather than just in theory. An eighth, deeply strategic element of Elon Musk's money approach, one that rarely gets discussed explicitly, is how he treats narrative, attention, and perception as financial variables that can either amplify or sabotage capital allocation. In conventional finance, narrative is often dismissed as noise, something secondary to fundamentals. Musk understands that while narrative does not replace fundamentals, it powerfully shapes the environment in which money moves. Attention influences investor patience, employee morale, regulatory tolerance, customer trust, and even access to future capital. Rather than attempting to suppress narrative risk through cautious messaging and polished public relations, Musk frequently embraces volatility in perception, allowing stories around his companies to swing between extreme optimism and extreme skepticism. This is not accidental. He appears to recognize that stable, boring narratives often produce stable but limited outcomes, while volatile narratives, though uncomfortable, can create windows where long-term capital is deployed with extraordinary conviction. By tolerating and sometimes provoking narrative turbulence, Musk effectively filters his investor base, workforce, and partners down to those who can withstand ambiguity and long horizons. Money follows belief, and belief is shaped by story. Musk does not try to make everyone believe at once. He seems content with having enough believers at critical moments. This selective alignment reduces friction when capital needs to be deployed aggressively, because those involved have already accepted uncertainty as part of the journey. Another subtle way narrative interacts with Musk's money strategy is through expectation management. Many leaders attempt to smooth expectations to minimize disappointment, promising incremental progress and predictable outcomes. Musk often does the opposite, setting audacious goals that almost guarantee temporary underperformance relative to stated ambitions. While this creates repeated cycles of perceived failure, it also stretches the collective imagination of what is possible. Money allocated under stretched expectations behaves differently. Teams push harder, investors think longer, and competitors react defensively. Over time, even partial success against extreme goals can exceed what would have been achieved under conservative planning. In this sense, narrative inflation paradoxically leads to operational deflation. Costs come down, processes improve, and capabilities advance faster because the target is far ahead. Money becomes aligned with aspiration rather than comfort. Critics often focus on missed timelines or overpromising, but this critique assumes that promises are meant to be predictions. Musk's behavior suggests that he treats them as directional signals rather than forecasts. The financial system surrounding his companies adapts accordingly, with money flowing toward accelerating progress rather than validating accuracy. Another important dimension of this strategy is how Musk uses personal visibility as a substitute for traditional marketing spend. In many industries, enormous amounts of capital are allocated to advertising, branding, and customer acquisition. Musk dramatically reduces these expenditures by leveraging attention generated through his own presence and statements. This does not eliminate marketing costs, it reallocates them. Instead of paying for exposure directly, he converts personal reputation and controversy into reach. This approach carries reputational risk, but it also frees substantial capital for investment in product infrastructure and cost reduction. In Tesla's case, this has allowed pricing flexibility that would be difficult to achieve with a heavy advertising burden. Money saved on marketing can be redirected toward manufacturing scale and technology improvement, reinforcing long-term competitiveness. This trade-off is rarely captured in financial analysis because the cost of attention is not neatly itemized on a balance sheet. Yet it has real consequences for how capital is deployed and compounded. Another overlooked aspect of Musk's relationship with narrative is his willingness to let negative stories coexist with progress. Many executives expend significant resources trying to control or counter unfavorable coverage, fearing that negative perception will undermine confidence and access to capital. Musk appears to accept a certain level of reputational damage as a cost of doing difficult things publicly. Instead of spending money to smooth perception, he spends money to improve reality, trusting that reality will eventually overwhelm narrative. This patience is not passive, it is strategic. By not overreacting to every wave of criticism, he avoids whipsawing capital allocation in response to sentiment shifts. Money continues flowing toward long-term priorities even when headlines are hostile. This consistency reinforces internal focus and prevents the organization from becoming reactive. Over time, repeated cycles where reality improves despite negative narrative strengthen credibility among those paying close attention. Another reason this strategy is ignored is that it requires separating ego from identity. Public criticism can feel personal, especially when it targets leadership. Musk's willingness to absorb reputational hits without immediately compensating through financial or messaging adjustments suggests a prioritization of mission over image. This detachment allows him to keep capital pointed at core problems rather than diverting it to reputation management. In finance, this is highly unusual. Many capital allocation decisions are subtly influenced by the desire to avoid embarrassment or protect legacy. Musk appears less constrained by these concerns, which expands the set of actions he considers viable. Money can be spent where it matters most, not where it looks best. Another critical element of this chapter is how Musk understands attention as a scarce resource that can be deliberately directed. By speaking publicly about certain topics, electric vehicles, space exploration, AI, energy, he elevates them in the collective consciousness, attracting talent, capital, and policy interest. This amplification effect reduces the cost of acquiring resources that would otherwise require substantial financial outlay. Engineers want to work on problems that feel meaningful and visible. Investors want exposure to narratives that shape the future. Musk's ability to keep his projects at the center of global conversation lowers the effective cost of talent and capital, even as it raises scrutiny. This trade-off is favorable when managed deliberately. Money saved on recruitment and fundraising friction can be redeployed into execution. Most people ignore this because attention feels intangible, but in practice it operates like leverage. Another subtle interaction between narrative and money appears in Musk's approach to predictions and statements about the future. He often speaks in conditional probabilistic terms, acknowledging uncertainty while outlining bold possibilities. This creates a narrative space where outcomes are framed as challenges rather than guarantees. Financially, this matters because it conditions stakeholders to expect variability rather than precision. When variability is expected, volatility becomes tolerable. Capital can remain committed through downturns because participants understand that deviation from a straight line is part of the process. This expectation setting reduces the likelihood of panic-driven capital withdrawal at critical moments. Money again benefits from psychological preparation as much as from numerical modeling. Another aspect of Musk's strategy is his willingness to let contradictions exist publicly. He may express optimism one moment and caution the next, depending on context. This inconsistency frustrates those seeking clean narratives but reflects a more nuanced internal model. Reality is complex and evolving. Narratives that capture that complexity are necessarily imperfect. By not forcing coherence at all times, Musk avoids locking himself into positions that constrain future action. Financially, this flexibility is valuable. Capital allocation can adjust as conditions change without being perceived as betrayal of a rigid story. Many leaders fear inconsistency because it can undermine trust. Musk seems to accept that trust built on honesty about uncertainty is more durable than trust built on polished certainty. This allows money to flow with less resistance when pivots are required. Another reason this dimension of his money strategy is ignored is that it operates at the intersection of psychology and finance, a space that many analysts are uncomfortable navigating. Financial models prefer stable inputs, narratives are messy and subjective. Yet markets are composed of humans, not equations, and human perception shapes capital flows in ways that cannot be ignored. Musk's intuitive grasp of this reality allows him to tolerate narrative chaos without losing strategic direction. Money decisions remain grounded in long-term objectives even as public interpretation oscillates. This ability to decouple internal conviction from external perception is rare and difficult to cultivate. It requires confidence not just in vision, but in process. This reveals that Elon Musk's money strategy extends beyond spreadsheets and factories into the realm of collective imagination. Capital is influenced by what people believe is possible, urgent, and worth sacrificing for. By continuously expanding that imagination, sometimes recklessly, sometimes clumsily, Musk alters the backdrop against which financial decisions are made. Money becomes more willing to chase ambitious projects when those projects feel inevitable rather than speculative. Most people ignore this lever because it is uncomfortable to admit how much finance depends on belief. Yet Musk's repeated ability to attract capital, talent, and patience around ideas that once seemed implausible suggests that narrative, when aligned with relentless execution, can function as a form of financial infrastructure. In his world, money does not merely respond to stories, it is shaped by them, disciplined by reality, and ultimately justified by outcomes that would not have been possible, without first expanding what people were willing to believe. A ninth critical component of Elon Musk's money strategy is how he treats discipline, not as restraint in spending, but as precision in where and how money is used. This distinction is subtle, yet fundamental. In conventional thinking, financial discipline is often equated with cost-cutting, budget caps, and cautious spending. Musk's version of discipline is far more demanding. It requires an obsessive focus on eliminating waste, while simultaneously being willing to spend aggressively where it actually changes outcomes. This duality is why his organizations can appear chaotic or extravagant on the surface while operating with an almost brutal internal efficiency. Money is not protected by slowing everything down. It is protected by ensuring that every dollar has a clear causal link to progress. Anything that does not directly improve speed, cost, quality, or learning is relentlessly questioned. This explains Musk's intolerance for processes, meetings, and roles that exist primarily to manage complexity rather than reduce it. From his perspective, such structures are not neutral overhead. They actively consume capital while slowing feedback loops. Cutting them is not austerity, it is optimization. At the same time, Musk is willing to authorize massive expenditures on equipment, talent, infrastructure, if they remove real bottlenecks. The discipline lies in discrimination, not frugality. This approach requires a deep understanding of the system being built, because without that understanding, it is impossible to tell which costs are essential and which are parasitic. Musk's engineering background gives him an unusual advantage here. He can interrogate expenses at a granular level, asking not just how much something costs, but why it costs that much, and whether the underlying assumptions can be challenged. This leads to a form of financial discipline that operates upstream of accounting, embedded in design choices rather than enforced through budgets alone. For example, instead of negotiating marginally better prices with suppliers, he often pushes teams to redesign components entirely, eliminating cost drivers rather than managing them. Money saved this way compounds permanently, unlike savings achieved through temporary cuts. This design-first discipline also explains Musk's emphasis on first principles thinking in financial decisions. By breaking problems down to their fundamental constraints, he avoids inheriting cost structures that exist simply because that's how it's always been done. Money is spent to rebuild from the ground up when necessary, even if doing so is initially more expensive. This may look inefficient in the short term, but it creates systems with lower long-term operating costs and greater resilience. Traditional finance often penalizes this behavior because it front-loads expense, but Musk's time horizon allows him to capture the downstream benefits. Another overlooked aspect of this discipline is Musk's treatment of personal and organizational lifestyle inflation. Many leaders allow rising revenues or valuations to justify rising complexity, headcount, and comfort. Musk resists this drift aggressively. Offices remain sparse, perks are limited, and expectations are high. This is not about symbolism, it is about maintaining sensitivity to cost. When an organization becomes accustomed to abundance, it loses the ability to distinguish between necessity and convenience. Musk's insistence on lean environments keeps trade-offs visible, forcing continuous prioritization. Money retains its signaling power because it is not drowned out by excess. This cultural discipline reinforces financial discipline, creating an environment where spending decisions are scrutinized by default rather than rubber-stamped. Another dimension of this chapter is how Musk treats errors in capital allocation. When money is spent poorly, he does not attempt to justify it retroactively through accounting narratives or sunk cost rationalization. He is often willing to admit mistakes bluntly and redirect resources quickly. This reduces the long-term cost of error by preventing bad decisions from being defended indefinitely. In many organizations, financial mistakes persist because admitting them carries reputational or political cost. Musk's relative indifference to such costs allows him to reallocate capital more fluidly. Discipline, in this sense, is not about being right all the time. It is about correcting course faster than others. This agility compounds over time, as small misallocations are addressed before they metastasize into structural problems. Another overlooked element is how Musk distinguishes between variable and fixed costs in strategic terms. He is wary of fixed costs that lock organizations into inflexible patterns, preferring investments that increase variable capacity or scalability. This does not mean avoiding infrastructure. It means designing infrastructure that can adapt. Money is spent to create optionality within systems rather than rigidity. This is why modularity, automation, and software-driven control recur across his ventures. These investments may be capital-intensive upfront, but they reduce marginal costs and increase responsiveness over time. Financial discipline here is about maximizing degrees of freedom, not minimizing expense. Musk's approach also challenges the conventional separation between finance and operations. In many companies, financial discipline is enforced by finance teams through controls and reporting, while operations focus on execution. Musk collapses this divide, embedding financial thinking directly into operational decision-making. Engineers are expected to understand cost implications. Operators are expected to think about capital efficiency. This integration reduces the friction and miscommunication that often lead to waste. Money decisions are made closer to the work, informed by real constraints rather than abstract targets. This decentralization of financial awareness is rare but powerful. It creates a culture where cost consciousness is everyone's responsibility, not just the finance department's. Another reason this aspect of Musk's strategy is ignored is that it lacks drama. There are no headline-grabbing announcements about discipline or cost control. Instead, it manifests in countless small decisions: redesigning a part, eliminating a meeting, simplifying a process, questioning a hire. These actions accumulate quietly, producing financial strength that becomes visible only later. Observers who focus on big capital raises or bold bets miss the underlying discipline that makes those bets survivable. Musk's willingness to spend billions does not contradict his discipline, it depends on it. Without relentless attention to efficiency at the micro level, macro level aggression would indeed be reckless. Another subtle but important element is how Musk treats opportunity cost. Money spent on one thing is money not spent on another, but opportunity cost also includes time, attention, and organizational focus. Musk is acutely aware of this, often canceling or deprioritizing projects that do not align with core objectives, even if they are profitable or popular. This pruning protects capital from being diluted across too many initiatives. Discipline here is about saying no repeatedly and publicly to ideas that would siphon resources without advancing the mission. This stands in contrast to conglomerate strategies that seek growth through diversification. Musk's refusal to pursue such paths reflects his belief that focus multiplies the effectiveness of capital. Another aspect of his discipline is psychological. By maintaining high standards and visible accountability, he creates an environment where waste feels unacceptable, not because of rules, but because of shared norms. This social pressure is more effective than formal controls, aligning behavior with financial goals organically. Money in this environment is respected rather than taken for granted. This also reveals that Elon Musk's money strategy depends not on restraint in ambition, but on restraint in distraction. Discipline is what allows bold bets to coexist with survivability. By being ruthlessly selective about where money flows, he ensures that aggressive spending amplifies progress rather than chaos. Most people ignore this because they equate discipline with caution and aggression with recklessness. Musk demonstrates that the two can coexist, provided discipline operates at the level of design, incentives, and culture rather than merely at the level of budgets. In his model, money works hardest not when it is conserved, but when it is deployed with clarity, precision, and an uncompromising intolerance for waste. The final chapter brings together every thread of Elon Musk's money strategy into a single unifying idea that most people still resist. Money is not the objective. It is the constraint that must be continually overcome in service of something larger. Throughout his career, Musk has behaved as if capital is temporary, fragile, and secondary to momentum. This belief explains why he never allows money to become a stopping point or a source of identity. Wealth is not treated as proof of success, nor as permission to slow down, but as a responsibility to tackle harder problems with higher stakes. In this sense, Musk's strategy is not ultimately about finance, investing, or markets at all, it is about agency. He uses money to increase his ability to act decisively in the world, to reduce dependence on external permission, and to keep options open when conditions change. This is why liquidity, while useful, is never hoarded for its own sake. Cash sitting idle represents unrealized potential, time not compressed, problems not attacked. At the same time, Musk does not romanticize spending. Every dollar must justify its existence by moving reality in a measurable direction. What emerges from this synthesis is a philosophy where money is always subordinate to mission, but never neglected. It must be respected, stretched, and constantly questioned. This perspective reframes many debates around Musk, whether about stocks, crypto, valuations, or predictions. When people ask what Elon Musk thinks about markets or assets, they often miss that his primary question is different. Does this deployment of capital increase the probability that the future I'm trying to build actually happens? If the answer is yes, volatility is acceptable. If the answer is no, even guaranteed returns are insufficient. This is why his financial behavior confounds both traditional investors and speculative traders. He is not optimizing for returns in isolation, nor is he gambling on sentiment. He is allocating capital toward trajectories, technological, industrial, and social, that he believes will compound over decades. Predictions in this framework are not forecasts of prices or dates, but assessments of direction and inevitability. He does not claim certainty about timing. He commits to direction and then uses money to accelerate convergence toward it. This is also why Musk's strategy is so difficult to copy. It demands more than capital. It demands conviction, competence, stamina, and a tolerance for prolonged discomfort. Most people want money to reduce stress and uncertainty. Musk uses money to increase stress in the short term in exchange for reducing existential uncertainty in the long term. That inversion is uncomfortable, which is why it is rare. It also explains why his approach attracts extreme reactions: admiration from those who see the coherence, and criticism from those who judge it using mismatched frameworks. Neither reaction changes the underlying logic. Over time, reality arbitrates. Systems either work or they don't. Cost curves either fall or they don't. Adoption either happens or it doesn't. Markets eventually adjust to these facts, but they do not create them. Musk's money strategy is built on this asymmetry. Reality moves first, money follows later. When viewed as a whole, the strategy is neither reckless nor mystical. It is brutally pragmatic. Capital is concentrated where it can change outcomes, risk is attacked rather than avoided, time is compressed wherever possible, incentives are aligned to behavior, discipline eliminates waste, narratives are tolerated but not obeyed, and markets are treated as reflections rather than instructions. The result is a form of financial behavior that looks unstable in snapshots but coherent over long arcs. For those willing to think beyond conventional finance, the lesson is not to imitate Musk's specific bets, but to question the assumptions behind how money is usually treated. Is capital being used to protect comfort or to create leverage? Is risk being hidden or being reduced at the source? Is time being discounted or being respected as the ultimate multiplier? These questions matter far more than any single stock, crypto asset, or market cycle. They define whether money remains a scoreboard or becomes a tool for shaping the future. And that is the deeper strategy most people ignore, not because it is secret, but because it demands a level of responsibility and long-term thinking that few are prepared to accept. If this breakdown changed how you think about money, investing, in long-term strategy, then this channel is built for you. On Elon Musk School, we analyze wealth, finance, markets, and technology through the lens of real decisions and real consequences, not hype or shortcuts. Subscribe to stay grounded in research-based thinking and share this video with someone who still believes money is the destination rather than the engine. The next lesson starts now.